I want you to imagine someone comes to you with the following investment opportunity. Meeting him at the office, the man is sharply dressed. You can smell a faint hint of leather on him from his sports car parked outside. He invites you into his office to sit down and talk business. Scanning the room, you see all his educational plaques and awards for Broker of the Year and such. We Americans love our experts. He leans back in his chair and proceeds with the pitch. Waxing eloquently about the markets and how complicated investment structure is. If you don't know what you're doing, the man touches on the topic of taxes. He discusses tax structure, the government, and inflation. He flips over a piece of paper he gave you about his tailored investment strategy for you and your family. He scribbles out a diagram on the back as to how the future could go if the economy continues the way it is. He reminds you that you don't pull your own teeth when you need dental work done. No one gives themselves open heart surgery. No one makes money in this economy without a good broker, he tacks on. After what you thought was a great meeting, you look a little more closely at the numbers of the deal he proposed. You notice something interesting. Obviously, you're putting up 100% of the capital. You're taking 100% of the risk, but if it makes money, he wants 60% or more of the upside to come to him in fees and other expenses. But by the way, if it loses money, you lose, and he still gets paid? What would you say? Hi guys, and welcome back to my channel. My name's Cory. If you're new here, I'm excited today. I want to talk about investing fees and how they've been labeled the silent killer of investors. If you stick with me to the end, I'm going to show you how you can save a potential 60% if you avoid these simple mistakes. Please don't forget to hit that like button and subscribe because it'll help support my channel. Now let's jump into the video. Mistake number 1, thinking that investing is too complicated, so I'll just hire somebody to do it for me. Now, the story I told you earlier actually happened to me. So my boss at work actually recommended that I talk to his guy at an investment firm that will remain nameless about saving for retirement and investing. Buried on page 8 of the contract, I uncovered a 5% charge for monthly premiums for the first 15 years and a $10 basic monthly charge. Now, to answer your question, my response to this guy was a very respectful no thank you. It was the only rational response that I could have given after looking through some of the documentation of the contract. But if I had gone to this guy 1 year earlier, I think I would have drastically underestimated the actual price I was paying for investing with this firm. If you're like 90% of Americans, these are the terms that you've already agreed to when investing with your buddy's broker in a typical retirement account. Now, why does this happen? Brokers are not bad people. I want to make that completely clear. Brokers are paid to funnel money to the investments that benefit them and the firms that they're working for the most. It's not set up for your broker to find the best investments for you. There are $13 trillion in actively managed mutual funds in the United States. How do you convince 92 million Americans to invest in a policy like this? It just goes back to simple marketing. With a little bit of research and education on the topic, you can avoid all of this. Mistake number 2, overlooking commissions and hidden costs. If you decide to work with a financial advisor, you want to make sure that they're upfront, honest, and transparent about all of the fees associated with the accounts that you're going to be using. Here are some fees to watch out for. Commissions on investments, ongoing monthly fees, total broker fees to the fund company, direct service fees, and total fees to execute the financial plan. The money you paid in commissions and other fees or ongoing monthly fees could be compounding for you. Let's take a look at some examples. If you made a one-time investment of $10,000 at age 20, assuming a 7% annual growth over time, you would have $574,460 by the time you were aged 80. But if you paid 2.5% in fees and other expenses, your ending account balance would only be $143,274 over the same period. Now let's see if we have this straight. You took all of the risk, you got to keep $143,000, but you gave up $439,000 to an active manager? That's 77% of your potential returns. Let's take another quick example, and let's say we have 3 brothers, all at age 35. They make an initial investment of $100,000, each with a different fee structure. Now, hypothetically, all 3 have the same performance in the stock market of 7% annually. They get together at age 65 and realize that the fees they were paying had a drastic impact on their returns. One paid 1% in fees, the other paid 2% in fees, and the last brother paid 3% in fees. $100,000 growing at 7% minus 3% in fees equals $324,340. The next brother, $100,000 growing at 7% minus 2% in fees equals $432,194. The last brother, $100,000 growing at 7% minus 1% in fees equals $574,349. The same investment amount, but drastically different returns based on their fee structures. Between 1 and 3% is almost double what the first brother made on top of the last. And lastly, number 3, there is still a way to win. David Swenson says that in order to have unconventional success, you can't be guided by conventional wisdom. Stick with me. I want to compare some low-cost index funds, which I've chosen to invest in order to lower my fees and drastically increase my returns. So I wanted to just take a look here for a minute at some index funds and their costs. So I want to compare, like we talked about earlier on in the video, mutual funds versus index funds. And I just wanted to show you for 1 minute down here the index fund net annual fund operating expenses. So this is 1.03% expenses. And this is what I'm talking about when I'm referring to mutual fund expenses. This is just one of the funds that could potentially be accessible to you in your 401k, your 403b, or an outside self-directed IRA account. But this right here is what I'm talking about. And I just wanted to compare. I have 2 other options for you to lower your costs. So I just wanted to take us to Vanguard. Vanguard is basically the industry leader in low-cost mutual funds. So I wanted to just take you down. We are in the US stock funds large cap, and I wanted to go down to the total stock market index, VTSAX. And I just wanted to click into it and show you the difference in expense ratios. So this is 0.04 and just compared to 1.03%. Just a drastic difference, major difference on your returns and your overall performance. Just real quick, let's go through. Fidelity is also another option. Now, Fidelity just came out with these pretty recently, within the last couple of years, zero cost index funds. So this is kind of Fidelity's answer to VTSAX and the other VOO, the S&P 500 index fund that Vanguard holds. So this is FZROX is the zero index fund from Fidelity, and it basically is total stock market index fund, very similar to Vanguard, but this is kind of their answer to Vanguard. So again, just wanted to make this comparison for you guys so you can see it clearly. This is just a great visual representation of the differences between just tracking down that annual net expense ratio. So important on your overall returns and your portfolio value. Well, thank you so much for joining me. I'm so glad you watched till the end of this video. Please like and subscribe if you got some value from this. It'll greatly help out the channel. Please leave a comment below if you have any questions or suggestions on future videos. Again, don't forget, if your money could talk, it would say, I'm a tool and a test. I'm a means and not an end. I can bring meaning to life, but I'm not the meaning of life.